The underlying thesis on my end and why you can stay bullish and stay long these stocks is because we can look through the SPR releases. We can look through a little bit of softening and see that there's a huge gap that's not because of ESG or anything that happened before February 24th of this year. That changed everything. When Russia invaded Ukraine, I don't think the generalists or the population at large, the investing public, understands how big of a hole that blew in the oil market. We are undergoing a period of demand destruction right now. And so we've seen that in some of the inventory data on the refined product side. Refined product prices have been extremely high. About $175 a barrel is what we've been looking at from diesel and gasoline prices. And so demand destruction was kind of inevitable. But on the other side of that, we've seen the Russia-Ukraine crisis opening up a gap between supply and demand that is going to be very difficult for the market to solve for just on demand destruction. And that remains our core thesis. So we see when the dust settles from everything that's happening over in the Ukraine, we see about a 3.5 to 4.5 million barrel a day deficit opening up between supply and demand. And again, the average recession, when you go through your average recession, when you're talking about demand destruction, you lose about 1.5 to 2 million barrels a day of demand that you get peeled off from a recession. So you're still left with a market that could be in deficit, which is obviously bullish for prices. And it's abnormal to be in this kind of a position. It all opens the door up for stagflation and a number of other things. And ultimately, you get price action and big swings like this, and the futures market is a little stretched on the long side. But underlying everything, when we kind of zoom into the market, x-ray the market, look at physical market indicators, I don't see the weakness reflected in physical market indicators yet. So yeah, some inventories are softening. Gasoline demand, diesel demand is falling off ever so slightly now, and the economy is obviously losing steam. So these things are impacting price today, but our core thesis doesn't change.
So I don't follow you on Twitter yet. Maybe I will after this. But a lot of the big energy folks on Twitter, whether it's Doomberg or Tony Greer or people like that, what I never hear out of those people is any acknowledgement that demand destruction exists. You know what I mean? Like, you're really the first oil analyst that I've talked to that has said, yes, demand destruction is real and it results in a 1.5 to $2 million a day shortfall. And I believe it's happening right now. At least it's starting, and I think that's really what's responsible for this drawdown in oil. Would you agree?
For sure. I think that there's a couple things. The market's had like a ton of bearish news flow thrown at it, and not just news flow, like real fundamental bearish events. And so it's not surprising to see it give back some of these gains. I mean, let's go back to right after the invasion. China does based on flight data that we track, the most severe lockdown of their country, given the zero COVID policy since February of 2020. So you had that, which is more than 1 million barrels a day offline right there. You've had obviously demand destruction from incredibly high refined product prices, like I said, between $170 to $200 a barrel, depending on the wholesale price and that you're capturing in the product you're looking at. So obviously you're going to get demand destruction there. We've always said that 5% of global GDP for crude oil price is where you start getting demand destruction. And we've been at that number. But under the surface, when you kind of go one step further and you look at gasoline, diesel prices, we've been at 7% of global GDP. So unsurprising to see demand destruction kicking in. And then the other big piece of the bearish puzzle has been SPR releases. So combined, the US and global SPR is releasing about 4 million barrels a day over the next 6 months. So that gap we're talking about, it's theoretically being filled up by this SPR release. So you have a lot of oil sloshing around out there on the global market, and you have demand falling. But it's important to think about, when you think about demand destruction, to think about the mechanics of the oil market. So when you or I pare back our expenditures on gasoline, let's say, based off of prices going too high, that's demand destruction, right? That's gasoline and diesel. But the ultimate buyer of crude oil is not you, me, or any consumer. It's an oil refinery. And so right now we're seeing crack spreads, refining margins at record levels. So even though we had a big drop today, there's really, you can't forecast any kind of slowdown in the amount of crude that's going to be consumed by those oil refiners. So refined product or crack spreads are still extremely wide, and there are a number of other indicators that tell me any pullback is going to be, relatively shallow. And you got to remember, this is the oil market, so it's super volatile, and 10%, $10 down feels like a lot, but these kind of days happen.
Yeah, one of the things you pointed out was the demand elasticity for oil. It's, it gets expensive and people drive less. Like that happens. So some of the conversations I hear around here in Myrtle Beach, people are still driving to work. Obviously, they have to drive to work, but you know, people who are lower income, middle income, they say, "Well, I was going to take a trip to Charlotte and that was going to cost me $150 in gas and I'm not going to go." So those are the types of things that I'm hearing. And if you look at charts of miles driven in the United States, like really just a 1, 2, or 3% drop in miles driven is a huge drop in demand for gasoline. I read something interesting recently that in California, they have a 3% drop in miles driven, but an 8% drop in gasoline demand because of all the electric vehicles that are being sold in California. So that's actually added up to, what's interesting is that all these years of selling Teslas and other electric vehicles, it's actually starting to have an impact on gasoline demand. Now that's not something you can trade on, but on a 10-year basis, if you had a 10-year thesis, that's important to know.
Absolutely, and I would not run away from that realistic aspect of the market. It's certainly not something that I'm not a permable, just so you know. So I hope you do follow me on Twitter. It would be, I just followed you today, so I'm looking forward to seeing what you put out there, even if we disagree. But I'm not a permable. Very realistic about the market, and what I would say is that we've seen a trend in miles driven actually going down for fuel gasoline consumption in the United States, really going back to the boom in SUVs and Hummers right before the GFC. So CAFE standards have gotten tighter, fuel efficiency has gone up, and we see that in gasoline demand. So there is kind of in developed economies a trailing off of gasoline demand. But you have to remember nowadays, really the big marginal buyer of oil is in the emerging economies, which I think the emerging markets and with dollar strength and things like that, demand destruction certainly coming there as well. So, I mean, again, the underlying thesis on my end and why you can stay bullish and stay long these stocks is because we can look through the SPR releases. We can look through a little bit of softening and see that there's a huge gap that's not because of ESG or anything that happened before February 24th of this year. That changed everything. When Russia invaded Ukraine, I don't think the generalists or the population at large, the investing public, understands how big of a hole that blew in the oil market. It's coming for us before too long.
So eventually we're going to run out of the SPR. I don't know if we'll take it to zero, but we're going to stop releasing oil out of the SPR. I mean, one of the things I was thinking about today is at some point in the next 6 months, 12 months, the G7 countries are going to have a common interest in bringing this war to a close. You know what I mean? Whether it's because of gas prices in Europe or oil prices in the US, like it's going to cause a lot of economic pain. And the G7 just met a week or two ago, and everybody was on board except for France and Germany, and it's getting interesting. So I mean, I don't know if you're a geopolitical analyst, but what do you? I mean, if Russia and Ukraine is the primary driver of this deficit, what happens when that primary driver goes away? Because the war's not going to go on forever, and my guess is it goes on for 6 months, 12 months, maybe 2 years, but that's about it.
Yeah, now you're getting to a true bear thesis for oil and energy. And that's, let's say we had a true resolution of the conflict. And it wouldn't just be a ceasefire necessarily. From my point of view, it would need to be something that uh, where we roll back the sanctioning regime that's been put in place. And so it would have to resemble somewhat of a political calculation from the G7, because that we aren't going to take the pain that actually the pain that we are trying to inflict to Russia via sanctions is actually hurting us as much, if not more, than it's hurting them. I don't think that's, from my standpoint, I'm not really a geopolitical analyst. We're much more quantitative analysts and look at the underlying numbers in the market. But we can have an opinion. We have to have an opinion about all these things. And I have a hard time seeing how this crop of politicians can walk back the statements, rhetoric, and actions that they've taken over the last 4 months regarding Russia and the sanctions. And you have certain things in addition to that I don't believe we can roll back from. And that's basically the exodus, the brain drain that's taken place in the oil and gas industry from Russia. In the history, when you see Western oil companies leave a country like Russia, history tells us that production falls off and it becomes a terminal decline.
Yeah, it was the same thing in Venezuela.
Correct. I mean, yeah, you're talking about a country with the largest reserves in the world. We've had terminal decline there as well. And so even if we go back, let's say there's a ceasefire, some kind of agreement there, do Western companies go back into Russia? I have a hard time picturing that. We have to have a real sea change in the narrative, the public zeitgeist, whatever you want to call it, in order for that to happen, in my view.